Good afternoon, everybody. We're going to go ahead and get started. I'm Sean Sloan at the Council of State Governments National Headquarters in Lexington, Kentucky, and this program is part of CSG's eAcademy series, a bi-monthly webinar series designed to provide information and training on the most critical issues facing state leaders, including the latest policy making and cutting-edge state solutions. Today's program is the second in a four-part series on risk management insurance and how insurance affects policy decisions. CSG has been excited to partner with the Griffith Insurance Education Foundation on this webinar and a series of other events over the last year on insurance-related issues. We've worked closely with Frank Tomasello, Program Director of the Griffith Foundation, and others on the Griffith team to bring you these programs. Frank's unable to join us today, but his colleague Jason Terrell is pleased to sit in. Let me call on Jason to say a few words about our collaboration. Jason?
Yes, thank you, Sean. Griffith is pleased to be collaborating with CSG. Together, our organizations provide an opportunity for public policymakers to gain an unbiased knowledge about risk management insurance. Our organizations share similar missions, which include a commitment to a nonpartisan, non-advocate, academic approach to programming. I look forward to introducing today's presenter, but first, let me send it back to you, Sean, for some logistics.
And a few details about today's webinar. First, this webinar is being recorded, so if you miss anything, it will be available on www.csg.org/knowledge center. Also, as I mentioned before, this is the second in a four-part series on risk management insurance. Every other Tuesday for the next month, we will have another webinar on a related topic, and you can check csg.org for more information. Finally, we welcome questions from you, the audience. If you'd like to ask a question at any time, just type it into the dialog box in the GoToWebinar interface, and we will ask our speaker as many questions as time allows today. And now back to Jason Terrell to introduce our speaker and get things underway. Jason?
Yeah, thank you again, Sean. We're pleased to be joined today by Dr. David Puser, who's an assistant professor of risk management and insurance at St. John's University. David received his PhD in risk management and insurance from Florida State University. His teaching interests include loss control, statistical tools used in risk assessment, and insurance regulation, just to name a few. Professor Puser regularly attends and presents research at regional and national academic conferences. We would encourage you to learn more about his background on the St. John's website. In the hour ahead, Dr. Puser will examine the underpinning of property and casualty insurance coverage. He'll do so through the lens of emerging concerns related to, among other things, catastrophes. Dr. Puser, thank you very much for joining us today, and the floor is yours.
Thank you very much, Jason, and thank you, Sean. This is hopefully going to be an informative webinar for all of you that are listening in. I'm going to talk to you about property and casualty insurance fundamentals today, and we're especially going to talk about how catastrophes affect the property and casualty industry, which has had a big impact over the past 15 years or so, and we're going to talk a little bit about, what the P&C industry is, what type of coverages it offers, and then give a little bit of a historical perspective on catastrophes. But just to give you a brief introduction on what this webinar is going to be about, the reason that we purchase property and casualty insurance is so that we are able to innovate in society. Homeowners feel more confident about buying nicer homes. Individuals are confident about driving to work every day, driving their families around because they know they have coverage if there's some kind of an accident or loss. Businesses are willing to innovate. Businesses are willing to build new warehouses and manufacturing centers. Businesses are willing to open themselves to the public and risk liability, risk property loss, and business interruption. So insurance as a general risk management tool reduces anxiety that we feel towards risky behavior. And we face risky behavior every single day by walking outside, by waking up, by inviting people into our homes and businesses. One of the major sources of uncertainty and risk to both individuals and businesses is catastrophe risk, which includes hurricane, tornado, earthquake, flood, terrorism, and more. We're going to discuss today how catastrophe risk represents the major driver of risk for both the insurance industry and for individuals and businesses. And so we're going to talk a little bit about how catastrophes are financed, how insurance companies deal with them, and how they've affected the industry so much. So looks like we're getting started here. So I'm going to dive into it. So what type of cat risk do we face? And you see that there are a number of pictures and bullet points flashing on the screen. And so a few that I wanted to talk about are listed here. From hurricane Homeowners and businesses face the risk of both moving groundwater, so flood, and we think about Hurricanes Katrina and Sandy driving these types of loss, as well as high wind. If we think about Hurricane Camille in 1969, Hurricane Andrew in 1992. If you remember Hurricane Andrew, I'm going to talk about this a little later in the presentation. Hurricane Andrew was a Category 5 hurricane that hit Florida, which means it had sustained winds over 157 miles per hour. We think about flood events, again, could be caused from hurricanes, could be caused from the break of a dam or a levee, could be caused by just regular storms flooding a river. Tornado, we can think about the Joplin or the Tuscaloosa tornado systems that hit about 5 years ago and caused many, many billions of dollars in damage, as well as hundreds of lost lives. Earthquake risk we see all around the world. In the U.S., we really think about the impact on California. And then we think about terrorism risk, and this picture I have here is the ruins of 9/11, the World Trade Center after 9/11. And so we know that terrorism represents a major risk not only to our lives and our livelihoods, but also to business owners and property owners. So these are some of the things we're going to talk about today, and a question that I have is, who pays for these cat losses? So how does society bear the costs of these events? And so the next slide, I'm going to talk about that a little bit. So next slide, please. So how do we pay for cat losses? Well, we pay through our savings as individuals. We can borrow money to pay for losses. Government will also often provide funding for catastrophes, either through bailouts or low-interest loans. Government will rebuild and fortify infrastructure. But a very large portion of cat losses are borne by the property and casualty insurance industry. And so how does the industry end up affording this? We're going to talk about that throughout the seminar today. And I think to understand how does the industry pay for these events, we need to understand how big catastrophes actually are. So next slide, please. Here we have the top 10 catastrophes that have affected the United States by property loss. So this is only property loss. I want to make that clear. This does not include liability, workers' compensation, health risks, anything like that. And the number one event that we have here is Hurricane Katrina, which I'm sure we're all familiar with. Inflation-adjusted Hurricane Katrina caused more than $49 billion in insured losses. This does not count the other uninsured and economic damages that the New Orleans and Mississippi and other Louisiana regions faced after the hurricane, but simply the losses paid by the insurance industry. And 2004 and 2005 were especially terrible, not just for the people living there, but also for the insurance industry, because the industry faced over $100 billion in catastrophe losses in that 2-year period. Very, very difficult for an industry to try to pay for that when they also have to pay for car losses, home losses from fire all over the country, business losses. So this was very difficult for the industry to bear. We see the 9/11 terror attacks as number 2 on the list with almost $25 billion in property loss. And this is actually only about half of the total insured losses from 9/11, because this also was a major workers' compensation, life insurance, and liability event for both the airline industry and for the World Trade Center area. Hurricane Andrew in 1992 was a redefining event. Hurricane Andrew changed the way that the insurance industry looked at catastrophes. And the last thing I want to talk about is Hurricane Sandy on this list, with about $20 billion in insured damages. And that's only about half of the insured damages, because the rest was paid through the National Flood Insurance Program at the federal government level. So next slide, please. So a little bit about the property and casualty industry. If we want to understand how insurance companies can pay for these losses, we need to understand these insurers. So there are more than 2,500 insurance companies writing property and casualty insurance in the U.S. The industry has more than $500 billion in net premiums written, which is revenue. The auto insurance industry makes up about 40% of industry premium, so over $200 billion in revenue just for car insurance. And the homeowners insurance industry is the next highest at about 15% of industry premium, or somewhere in the 80 to 90 billion in revenue per year. There are about 600,000 people directly employed by the property and casualty industry, but the entire U.S. insurance industry includes more than 2.5 million people employed. And so we're going to talk about some of the types of losses that are insured, so I'll do that on the next slide. Oh, I'm sorry, this is the top insurance companies, so I'll get to that in a moment. But so the top 10 largest U.S. P&C insurers, we have State Farm at number 1 with close to $60 billion in revenue. and a big jump down to number 2 with Allstate and Berkshire Hathaway, roughly the same size, Liberty Mutual. All three of these are roughly at about $30 billion in revenue. And if you are not familiar with Berkshire Hathaway, this is Warren Buffett's company, and their biggest insurance company is actually Geico. So when you see Geico, you should know that Warren Buffett is the biggest shareholder. But overall, it's a very large industry, and there are some really big companies that make up this industry writing, you can see here, even at the bottom of the list, we have $19 billion in premiums written.
Professor Puzder, this is Jason. We had a question come in around competitiveness. The question is, the top 10 insurers write a really large amount of total industry premiums. Is the industry competitive, or do these few insurers control the market?
Well, I think you've seen a lot of, I'm sorry?
And I can repeat that if needed.
Oh, okay, thank you. So the question is the property and casualty insurance industry competitive, or is it being moved by a small number of companies? Because we see that these top 10 companies have a huge market share relative to the $500 billion in total premiums written. I would say by and large, yes, the industry is very, very competitive. As I mentioned on the previous slide, there are more than 2,500 insurance companies writing insurance in the U.S. In general, if one insurance company decides they want to raise rates too much, other insurance companies are going to fill the gap. So it's any line of business for the most part, especially the lines of business that are being targeted towards individual consumers. So homeowners insurance, auto insurance, and while a different industry, but life insurance, health insurance. These individual markets have dozens and dozens of insurance companies competing for their business in any given market. So if State Farm decides they want to raise auto insurance premiums by I don't know, make up a percent, but 15% or 20%, and there's no justification for it, there's not an underlying change in the risk, other insurance companies can simply offer a lower price and eat away at that business. So I think that in general, yes, the industry is very competitive, and while these companies are very big, they're not necessarily moving the market in any way. Okay.
Thank you.
And we can go to the next slide if there are no more questions.
No, we're good.
Okay. Okay, thank you. So I want to talk a little bit about the risks that are covered by the industry. There is property risk. So when we say property and casualty, what do we mean? Property risk is risk to real and personal property. Real property includes buildings, typically. So we're not insuring land, but we do insure structures and permanent attachments like garages, fences, things like that. And personal property is anything that you can move, anything that you can pick up or can be moved from a real structure or other mobile equipment like cars, bulldozers, and other heavy machines that businesses use. And property risk can be either direct or indirect. Direct property loss is the direct loss of property, so the cost to replace, rebuild, repair. Indirect property losses, however, should not be ignored by individuals or businesses. Indirect loss is actually lost revenue or increased expense after a direct property loss. So if you're a restaurant which suffers a major kitchen fire, you have to pay to repair your restaurant, but you're also going to lose revenue during that period. Similarly, if you're a homeowner and you have a fire in your home, you have to pay to replace or repair your home, but you might also have to rent a second dwelling for a time while your home is being repaired. So indirect loss is also a major driver of loss, both for individuals and businesses, as well as for the insurance industry. So next slide, please. So the other side of the property and casualty insurance industry is casualty, which is kind of a broad term, but casualty typically includes liability risk, the risk of lawsuit, also covers the risk of a legal defense. So insurance companies typically will also pay for a lawyer and any legal benefits like that. And casualty can also include other types of coverage like workers' compensation insurance, accident and health coverages that businesses purchase, and some service products like inland marine, boiler and machinery equipment breakdown. Next slide, please. So I want to talk a little bit, just briefly, about some of the major types of insurance coverage. And I mentioned that auto and homeowners insurance make up the majority of industry premiums. More than half of industry revenue comes from these two sources, simply because there are so many people that have cars and so many people that have homes. So this is a volume business. It's not necessarily really big premiums, but there are so many people that purchase these policies. I'm also going to talk about some federal catastrophe coverages, and I'm going to give you the rationale for why the federal government does provide some insurance policies. And I want to briefly mention a little later reinsurance as well as the excess and surplus lines industry. Reinsurance is an insurance policy for insurance companies, in essence, and the excess and surplus line industry typically covers high-risk policies, unusual risks, and hard-to-place risks. Next slide, please. Policy we're going to talk about, and I'm very briefly going to talk about the coverages within. I'm happy to answer any questions about it if anybody has, but just since we're kind of pressed for time, I'm not going to spend a lot of time on this. But the personal auto policy makes up the majority of industry premiums. The other side of auto would be the commercial auto industry. But you know, there are 320 million or so people in the United States. A huge portion of those people drive, and everybody that drives is required to own car insurance. So auto insurance is the largest industry in the United States, as I mentioned earlier, based on volume, simply because there are so many cars and so many drivers. The auto policy is designed to protect both the individuals in cars, individuals in other vehicles, as well as pedestrians, and to protect the owner of the vehicle from damage to the car from various types of accidents. So next slide, please. There are 4 parts of the auto insurance policy, and some states also have a personal injury protection part to the contract, but Part A is the most important part of car insurance. It's liability protection. Liability protection does not necessarily protect the driver of the vehicle, but other drivers on the road, as well as pedestrians. Liability required because state governments typically say, well, if you're driving a car, you're driving a 2-ton giant piece of metal that's capable of going 100 miles per hour, you can cause significant bodily injury and property damage to other people. So we need you to be able to protect those people. Those people need somebody who they can hold financially responsible if you do cause them harm or damage. So liability coverage covers the lawsuit, judgment, for bodily injury, as well as property damage to other people on the road. So this is a third-party coverage. It does not cover your car, and it does not cover you as a driver. Part B of the auto policy are medical payments, and these typically include if you are in a vehicle or acting as a pedestrian, so walking, riding in somebody else's car, driving in your own car, and you're injured in an accident, medical payments will cover things like the ambulance ride, the doctor's visit, and any follow-up doctor's visits you might require because of an auto accident. Part C of the auto policy is uninsured or underinsured motorist coverage, and many people think that if you are hit by a driver without insurance, this pays for both damage to your vehicle as well as injury that you sustain. But uninsured motorists, as Part C, is actually only for bodily injury, so this does not cover any damage to the vehicle. This doesn't have any property portion, but uninsured motorist essentially places an insurance policy onto the person that causes an accident, including hit-and-run drivers, as well as drivers that don't have insurance. So if you're acting, again, as a pedestrian, riding in somebody else's car or driving in your own vehicle and injured by a third party that does not have insurance or hits and runs, this will pay for bodily injury. In some cases, it'll pay for lost wages and rehabilitation as well to the owner of the insurance policy. The final major part of the auto insurance policy is Part D, and this is one that we're probably most familiar with because this covers damage to the automobile. And there are two parts to Part D. There's actually collision coverage and other than collision coverage. So collision coverage covers the upset of your vehicle with another object like another car, a tree, a fence post. Other than collision damage other than collision coverage will cover damage from things like animals, falling objects, theft, vandalism. And this is a first-party coverage only. It only covers damage to your vehicle, not to other vehicles. And it typically has an associated deductible. Some people choose $250, some $500, some $1,000, and there are obviously different deductibles you can choose. But this is an optional coverage. So you do not have to buy Part D coverage. But if you drive a nice car, you want to have this because you want to protect your vehicle. And personal injury protection is similar to medical payments in a lot of ways. This essentially says, okay, we want to keep minor car crashes that cause injury out of the court system. So we're going to say that in minor injuries, typically damages that don't exceed $10,000, we don't want there to be a lawsuit stemming from this. So everybody's own coverage, everybody's own insurance will cover them for loss. And this includes medical costs, ambulatory costs, rehabilitation costs, as well as lost wages. And the design of the policy is to try to keep a lot of these minor lawsuits out of the court system so that they can focus on more major types of lawsuits and events. Next slide, please. So since the theme of this presentation is the property and casualty industry and catastrophes, I want to talk a little bit about catastrophes in cars. And so it's not really a major type of coverage for insurance companies. Catastrophes tend to be those events that cause hundreds of millions of dollars of damage or more. And so while automobiles certainly are damaged by hurricane, earthquake, tornado, flood, it's not as much of a focus as homes and businesses and structures in a catastrophe. So auto insurance is really not a major source of catastrophic risk. And part of that is also because many evacuations involve a personal vehicle. So if you know a hurricane is coming, you get in your car and drive away. So cars are not as exposed to catastrophic loss as homes and other business structures. So we don't worry about that quite as much in the auto insurance industry. Okay, next slide, please. So the next thing I want to talk about is the homeowners insurance policy, and so most of you probably own a home. Some people rent as well. I live in New York City, and so home ownership is one of those pie-in-the-sky dreams that we all have someday of, you know, paying $1 million for a 400 square foot apartment somewhere. I might be exaggerating a little bit, but anyway, so we all own or rent a home. So renter's insurance is in the same vein as homeowners insurance, but this is a multi-peril, multi-line policy which covers both property risk and liability risk. So for individuals, this is a must-own policy. And not everybody buys this. It's not required unless you have a mortgage on your home. And so if you have a mortgage, you have to have homeowners insurance. So I want to talk a little bit about the coverages that exist. So next slide, please. Just in general, in the homeowners policy, we have two types of coverage. We have property coverage and liability coverage. Next slide. Within property coverages, we have four types. We have four main coverages, coverages A through D. And coverages A and D cover real property. It covers the home and any other permanent structures like a detached garage, a pool house, a tool shed, a storage shed, something like that. And typically, coverages A and B to the structures on the property pays on the basis of replacement cost, which is unusual for insurance. A lot of insurance policies pay on the basis of market value or depreciated value. But from a policy perspective, it's very good to allow homeowners to rebuild their homes. So as long as the insured buys a sufficient amount of coverage, they will be allowed to get replacement cost coverage even for very old homes. The perils that are insured against, the perils are the cause of loss, such as fire, explosion, windstorm, hail, and more, depend on the policy. Some policies are sold on what's called a named perils basis, which means that all of the covered types of loss are listed in the policy. Others are sold on an open perils basis, which means that everything is covered unless it's specifically excluded, such as flood, earthquake, war, nuclear disaster, and a few others. Next slide, please. So coverages C and D, also within Section 1 of the homeowner's policy. Coverage C covers personal property, so the things that you own in your home, your furniture, your appliances, rugs, clothes, electronics, gadgets, whatever in the home that's not permanently attached is considered personal property. And an important part of coverage C is that it covers your personal property anywhere in the world. So if you're taking a vacation, let's say that you live in Pennsylvania and you want to take a vacation to California, you pack up, if you're a man, you pack up a couple of nice suits, you pack some casual clothes. If you're a woman, you pack maybe some nice dresses. You know, if you want to go out, you pack again some casual clothes. Maybe you have some nice jewelry, a watch or a necklace or whatever, and you bring your computer. So you bring several $1,000s of stuff with you on your vacation. And it's destroyed in a fire, or it's stolen from your hotel room, or it's destroyed by some other cause of loss that's covered in the insurance policy. The homeowner's policy will actually pay for your stuff, even when you're traveling, even when it's not in the home. And the final property coverage that's within the homeowner's policy is called loss of use coverage. So this covers increased living expenses after a loss to the home. So if your home suffers a fire and you have to rent a home for a time, it'll pay for that. If you were renting out a portion of your home to somebody else and then it's uninhabitable because of a loss, it will also pay for loss rental coverage or loss rental dollars during that period. Next slide, please. Section 2 of the homeowner's insurance policy covers liability risk, and this includes bodily injury to people who come onto your property, as well as bodily injury that you might cause off your property. So if you're playing a softball game and you accidentally line drive the ball to somebody, they're injured and they decide that they want to sue you for that, your homeowner's insurance policy will pay for a legal defense and pay for any potential judgments from that as well. It will also pay for property damage if you borrow your neighbor's lawnmower and you run over a giant stump and it breaks. It will pay to replace that, and that's kind of a good neighbor policy. This helps people to maintain good relationships with the people around them. The medical payments are also a liability coverage, but this is one that doesn't have to make it to the court system. So if somebody comes onto your home premises and they have a minor injury, in some cases maybe a dog bite or a cat scratch, or they fall and twist an ankle or something, medical payments will pay for first aid, urgent care, and emergency room visits up to a predetermined amount, which might be like $5,000 or $10,000. So this is to try to prevent lawsuits by keeping your visitors happy. I mean, and I don't want to say happy, but not to the point where they want to sue you. So that's the idea behind medical payments. And so we can go to the next slide if that's okay. So from a catastrophe perspective, catastrophes have a major impact on homes, on homeowners insurance. And so this is important from a policy perspective because your constituents mostly own homes or live in homes, and the protection of those homes is driven by homeowners insurance. And so when catastrophes occur, insurance companies have a tendency to kind of close up their books. They get very reticent about writing homeowners insurance. And so one of the major loss drivers in homeowners insurance are catastrophes, and in California that can be from earthquakes or wildfire. In the southeast United States that's mostly from hurricanes. In the Midwest that could be from tornadoes. In other parts it could be ice storms and blizzards. But major catastrophes cause huge dollar losses for insurance companies. If you hearken back to the table I mentioned earlier, you can see that there are events that cause tens of billions of dollars in damage, and it's very hard for insurance companies to pay for that. So as we go forward, I'm going to discuss federal catastrophe coverages like the National Flood Insurance Program, as well as reinsurance, which helps insurance companies provide this catastrophe protection. Okay, next slide, please.
Professor, we have a question that came in.
Oh, yeah, okay.
So the question is, are companies that write homeowners insurance based off of catastrophes thinking about changing coverages or, I guess, even dropping out of the market?
So, yes. I would say right now, no. We've had relatively calm last few years, but this is something that we do see frequently after major catastrophe events. Insurance companies just in really bad states, and so Florida would be the clearest example. Insurance companies just don't want to write insurance there anymore. They see that the potential cost of covering these catastrophes far outweighs any benefit that they might make from writing the insurance. And so nationwide, pretty much stopped writing insurance in Florida, homeowners insurance in Florida, back about 2004 or so, right before the major catastrophes hit. State Farm dropped out of the market in 2005. After Hurricane Andrew, as well as the 04 and 05 seasons, we saw a lot of insurance companies go bankrupt from writing in the state of Florida, Louisiana, Mississippi. So catastrophes do have a major impact on the insurance market, and that spells kind of a big impact on consumers as well, who are counting on these insurance companies to provide stable coverage. So the state of Florida in particular has responded by providing state reinsurance protection at a kind of a reduced rate to primary insurance companies in there. But that's something that insurance companies really have to think about, is how are they going to cover those big catastrophes? How are they going to respond to them? And are they going to leave the state or leave that market if they see the risk as being too great?
Okay, thank you.
Okay, sure thing. I'm going to talk a little bit here about federal catastrophe insurance programs. And so the major, I guess, reasoning behind these types of coverage is that some losses are considered too big, are too widespread, too systematic for private insurance companies to cover. So I'm going to talk about just a couple of programs here, the federal crop insurance and national flood insurance programs, but you can also think about, FDIC coverage for banks, Social Security as private pension insurance. These really widespread risks are often covered by the government. And so next slide, please. So why, I mentioned this a little bit on the last slide, but why are these risks covered? Well, crop risks are often systematic, meaning that many farmers suffer losses simultaneously, and especially those losses that are caused by major storms, by flood, by drought, by pestilence. You know, I think harking back to Moses' time, but this happens as well to other farmers. Really widespread losses. Flood risks are the same. When one loss occurs, it typically covers many hundreds or many thousands of people at the same time. And these events are sometimes too great for insurance companies to handle. So crop risk and flood risk have both been picked up by the federal government through the National Flood Insurance Program and the Federal Crop Insurance Corporation to help pay for these losses. And next slide, please. And so another major financing source insurance companies use to pay for catastrophe loss is reinsurance. And so reinsurance is essentially insurance for insurance companies. Reinsurance can be used for several purposes, which we're going to talk about, but one of the major sources, or one of the major purposes of reinsurance, is to provide catastrophe layer protection to insurance companies. And so next slide, please. So within reinsurance, an insurance company is actually transferring part of the liability for a loss to the reinsurance company, much like an individual would transfer their risk of home damage, risk of car damage to a reinsurance company. The insurance company transfers that same risk on. The transactions tend to be much larger. They involve a lot of expertise, and they can sometimes take many months or many years even to craft a contract that they agree upon. But this is another form of risk transfer and protection for the insurance company. Reinsurance companies tend to be a little better at spreading the risk, so oftentimes primary insurance companies are concentrated in one geographic region, whereas reinsurance companies operate globally. And there are two primary types of reinsurance coverage. One is excess of loss reinsurance, in which a reinsurance company will pay for losses that exceed a predetermined threshold for an insurance company. So let's say we have an insurance company which is operating in Mississippi, and it doesn't want its liability for one single event to exceed $500 million. So they could buy reinsurance coverage that would pay for all losses over $500 million from one event. Another type of reinsurance coverage is called proportional reinsurance. So for example, let's say we have an insurance company in North Carolina which wants to grow its homeowners insurance market but doesn't have the capital or capacity to do so. The insurance company can enter into an agreement in which 50 cents of every premium dollar is sent to the reinsurance company, and 50 cents of every lost dollar is paid by the reinsurance company. And it seems like a wash, and it kind of is, but the purpose is to allow the insurance company to grow its business, typically. Next slide, please. So things do reinsurance companies pay for? What are some of the benefits of reinsurance? Well, reinsurance companies can pay for, as I mentioned on the last slide, excess losses, very, very expensive single properties, very expensive catastrophes. Reinsurance can cover those. Reinsurance can help an insurance company grow. It can improve its capital performance. So it looks like the insurance company is more financially stable when it has good reinsurance. And this is good for policyholders because it means that the insurance company will be more likely able to meet its financial demands in the event of a major loss. So reinsurance is good for primary insurance companies and therefore is good for policyholders. And another kind of added benefit of this is that reinsurance makes primary insurance available. If it was not for reinsurance, many primary insurance companies would have anxiety or fear about writing in catastrophe markets. But because reinsurance exists to protect them in those cases, they're more willing to extend homeowners insurance to people that live in North Carolina, South Carolina, Florida. Sorry, Georgia, I'm not skipping Georgia, but they have, less catastrophe exposure there. Florida, Alabama, Mississippi, Louisiana, and Texas, those hurricane states. Insurance companies that are operating in California with wildfire exposure, in the Northeast with blizzard and major storm exposures. So insurance companies feel more confident when they have reinsurance, and this helps consumers. But of course, this additional layer of risk transfer is not free. So the cost of risk and reinsurance is simply that there's an additional layer of risk transfer. Reinsurance companies have salaries to pay, profit to make, taxes to pay, so they have to charge a higher premium. And in general, policyholders do not collect directly from reinsurance companies. They have to collect from their own insurance company first. and then the insurance company collects from reinsurance for a major loss. Next slide, please. So I think I mentioned about 2 slides ago that reinsurance companies often operate globally, which is a good thing in terms of risk transfer. When we have risk concentrated in one single area, one major loss to that area can disrupt the entire insurance market because the insurance has all of its property concentrated. It can have thousands or even millions of properties impacted simultaneously. Reinsurance companies take a portion of risk from all over the United States as well as all over the globe and spread that risk. They spread it beyond not just one country, but entire continents and sections of the world, which gives us a lot of diversification, but it's also kind of major for the reinsurance industry when big catastrophe events happen, not just in the US, but globally. So reinsurance companies have been impacted majorly by several events over the years, but Hurricane Andrew was a really big one in 1992. The 9/11 terror attacks were a major event for the insurance industry, borne in large part by the reinsurance industry. Same with Hurricane Katrina, and then global disasters have big impacts on the U.S. as well, such as the Tohoku earthquake I believe that was in 2011. The major earthquake in Japan caused more than $250 billion in economic losses, $30 to $40 billion in insured losses. The Christchurch earthquake in New Zealand, I think around the same time period, was a $10 or $20 billion insurance event. So these are global disasters that have a big impact on the reinsurance market, which can then create a big impact on the U.S. insurance market because reinsurance companies' profits go down, they have to charge higher prices, and so insurance companies have to respond also by charging slightly higher prices. So the global risk transfer is in general a good thing because it means we're transferring the risk of earthquake, hurricane, wildfire, tornado to another region of the globe, but it also has a cost in that global catastrophes also impact the U.S. insurance market. Okay, there are some major types of catastrophe loss that are often excluded. The 2 primary that we see excluded from most insurance policies are flood and earthquake. And the reason for that is that these are very old, well-known types of loss. Flood has been happening for hundreds of years and has been recorded for hundreds of years. And the same is true for earthquake. And so insurance companies were able to respond a century ago or more by making these unavailable from their insurance policies. We also see some covered catastrophes, notably hurricane, tornado, wildfire. And part of that is that these types of catastrophes are relatively young in terms of the damage that they cause. So a lot of the hurricane damage that is caused by flood is excluded anyway because flood damage is excluded, but only if that flood is caused by rising groundwater, so tidal surge. When flood is caused by rain, if it just simply rains a lot and deluges an area, that's actually covered by an insurance policy. And same with any wind damage from a hurricane or tornado. These are often covered as well. Some insurance companies are responding to hurricanes by increasing the deductible that homeowners have to pay in the event of a hurricane. We're also seeing a lot of wildfire coverage, especially in the West. And some insurance companies are responding by trying to leave that market by going somewhere else or just not writing coverage there anymore because they don't see it as being profitable. So just in general, to reiterate if that wasn't clear, we see a lot of exclusions because the risk is very well known, very well documented, and a lot of covered catastrophes because we're still finding out about these catastrophes and insurance companies have not moved to exclude them from their policies yet. Another big one is terrorism risk, and of course, you know, the major terror event that we can all point to is 9/11, not only from a national security perspective, but also from a property loss and casualty loss perspective. 9/11 is one of the most major events to ever impact the insurance industry, and insurance companies moved to exclude terrorism as a cause of loss after 9/11. But the federal government responded with the Terrorism Risk and Insurance Act, or Reinsurance Act, I can never remember, but TRIA provides underwriting for terrorism risk by the federal government. And next slide, please. So some major catastrophe periods that we've seen in the United States. In 1992, we had Hurricane Andrew, and Hurricane Andrew was very significant because it changed the way the insurance industry viewed catastrophes. 13 insurance companies in Florida went bankrupt after Hurricane Andrew because they didn't have sufficient reserves to pay for the major losses that occurred then. And so this kind of changed the way that insurance companies perceived hurricane risk and other catastrophe risk. In 2004 and 5, we had the Atlantic hurricane, an unbelievable Atlantic hurricane season with something like a couple of dozen landfalling hurricanes in that 2-year period, and more than $100 billion in insured loss just in that 2-year period. And that's, you think about an industry whose annual revenue is $500 billion, 20% of a year's revenue is wiped out in 2-year period. This doesn't include all of their other losses from fire, from theft, from vandalism, explosion, vehicle crashes, business interruption losses, lawsuits. This is just from Atlantic hurricanes. So this was a major 2-year period, and most of the losses were actually covered by reinsurance in 2004 and 5. Hurricane Katrina came from the 2005 season. It's the most costly insurance event in U.S. history. And since 2005, we've actually had some pretty mild years in terms of catastrophes, mostly, one loss per year. I think Hurricane Ike in 2008, Hurricane Irene in 2011, Hurricane Sandy in 2012, and these were significant events, but only one. So we didn't have multiple hurricanes making landfall. So 2011 was a pretty bad year for catastrophes, but mostly because of tornadoes, actually. So I think that might have been the year that we had the Joplin and the Tuscaloosa tornadoes. And 2012, Sandy was a major event, but a lot of the property losses were borne by the federal government, by the National Flood Insurance Program. And so one question I would ask is, who pays for those losses? Who pays for the flood insurance losses? And the answer is, well, probably the taxpayer. So a lot of those flood insurance losses will be picked up through tax revenue or something like that. Next slide, please. And so this discussion of catastrophes leads me to a documented trend in the insurance industry, which is the underwriting cycle. And within the underwriting cycle, we have periods of high price and low coverage. So high price for insurance, expensive insurance, and not many insurance companies offering coverage, which will lead to, and that's called a hard market, which will lead to a soft market where we have periods of lower insurance prices and very, very available, widely available coverage. And this is maybe, so we're seeing a disruption in the underwriting cycle right now, which is maybe a good thing. Maybe we've broken the cycle, but there's a theory that catastrophes can actually disrupt or change the underwriting cycle. So if we have a soft market, we have a lot of insurance and it's available for a low price, and then a big hurricane comes through, insurance companies are going to suffer billions of dollars in loss, and so they're going to respond by shrinking their coverage. They're going to pull back their coverage and they're going to increase their prices to try to recoup some profitability, or because they think that the risk has changed in some way. And it's actually kind of a natural movement, though, the hard to soft market, because if we do have high price and low coverage, insurance companies are making a lot of profit. And so other carriers, other insurance companies say, well, I want some of that profit as well. So they compete based on price, which leads to prices going down, coverage going up because there are more market players. And so prices then get very low again. There's more insurance companies in the market, and then a major loss happens and it switches back to a hard market. And so this is, I think, kind of a logical trend, actually. Okay, next slide, please. And just, I kind of mentioned this a couple of slides ago, but I wanted to talk a little bit about some specific periods in catastrophe coverage. So Hurricane Andrew in '92, I mentioned that. So this had a major impact on the U.S. property and casualty industry, changed the way that insurance companies priced catastrophic risk, and also changed the way that they reserved. So we saw a lot more cash reserving for catastrophes, insurance companies that were hoarding or holding on to cash in order to pay for these major events. Before 2004, we saw a softening market. There hadn't been a lot of major catastrophes in recent years. Reinsurance was widely available. Investment returns were going way up after 2002 or so. We started seeing investment returns go up, and so insurance was available. Prices were fairly low, and then 2004 and 5 happened, and there was just this major hit. And after this major hit, what actually drove the market after 2005 was the reinsurance market. So reinsurance companies paid for most of the catastrophe losses in 2004 and 5. And they said, well, hold on, we can't afford this. We can't afford another year of this. So reinsurance companies started rescinding coverage to insurance companies, and they started raising prices dramatically, 40, 50%. And the primary insurance companies basically had to respond in kind. They said, okay, well, our price of reinsurance is going through the roof. Our reinsurance availability is going away, so we have to shrink our coverage and raise prices as well. And so certain states were hit by this more than others, primarily Florida and Louisiana. And insurance companies, you see I have a little bullet point about this on this slide, insurance companies make a lot of their profit through investments, through bonds and stocks. So we think about what happened after 2005. Well, about 2 years later, we saw the financial crisis begin. And so investment returns also started to decline right after these major catastrophe losses. And so that had a big impact on the market. Next slide, please. And so we saw that the insurance coverage actually kind of declined after 2005, kept going down, and then maybe after 2008 or 9, we saw insurance coverage start to increase again. So part of that was because there weren't a lot of catastrophes going on in each year. There might have been one per year, but there weren't a lot going on in each year. And so insurance coverage started increasing again. But, and this is where we see a contrary kind of example to the historic insurance cycle, the market cycle. While insurance coverage is increasing, we see more and more insurance companies offering coverage, prices haven't really gone down very much. And so that's a big question, is why have prices remained relatively high? And maybe the answer to this, I think there are a lot of theories, but a big hypothesis behind this is that it's because investment returns haven't been very good for insurance companies. So insurance companies have been very hedged against the market since 2008 and 9. They have not been seeking high investment returns. And so to make up for that lost profit from investments, they're charging higher prices for their insurance coverage. But based on this recent phenomenon, based on this recent observation, a lot of people are asking if the underwriting cycle, if that market cycle from hard to soft market is over. Is it still going on? Are we going to see similar changes in the future? And we're just going to have to, I guess, wait and see in that regard. Next slide. Okay, and so how prepared is the industry for another catastrophe? Well, that's I guess the question of the hour. We don't really know that until one actually happens, but we think that the industry is much better prepared now than it has been in the past. So insurance companies hold a lot more cash, which is good and bad, right? When companies hold cash, they're not investing it. They're not using it for growth and innovation. But from a risk management perspective, it's a good thing. From a regulatory perspective, that's a good thing. It means that insurance companies are safer. They're safer if that major catastrophe happens. They're able to pay those claims. They're not going to go bankrupt. Because if an insurance company goes bankrupt, the taxpayers, the state, is on the hook for that. So we're happy that insurance companies are holding more cash, even though it does have a cost. It has an opportunity cost. But regulators are even supporting this holding of high cash reserves. And another source of market support for the insurance industry is coming in part because investment returns were very still for a couple of years. So after the financial crisis, a lot of companies said, okay, well, stock market's really bad, bond market's really bad, real estate market's really bad. Where can we park our money to make money? I guess that's a little repetitive, I apologize. So where can we park our capital to make profit there? I restated. Where can we put our capital? Where can we make some money in investment that's not stocks and bonds? And they said, well, how about insurance? Profits in insurance is in no way driven by a financial market. Profits are driven by catastrophes, by fires, by natural and man-made events, but not by stock market crashes, not by bond markets. So we saw the capital market through hedge funds, through investment funds, through just alternative sources of capital flowing into the insurance market. And that might be part of the reason, actually, that insurance is so much more widely available, is that there's not only support from the insurance industry and the reinsurance industry, but because financial markets are also pouring capital into the industries. Okay. I think that's what I have here, so I welcome any questions that are available.
So, Dr. Puzo, thank you very much. We do have a few questions that came in last minute. One actually specifically just came in for your last slide, which is they really want to understand how hedge funds are working to help manage the catastrophic risks.
Okay, yeah, you see I have a bullet point there about hedge funds, and it's kind of through what I was just talking about. So hedge funds, to colloquially, I guess, hedge funds are investment funds for fairly wealthy people, people that have a lot of capital that they can try to invest, and they're seeking high returns. And just as a general finance theory, we often seek to invest in uncorrelated types of markets. So if the stock market's going down, we want one of our investments to be going up or to be staying stable. So we seek uncorrelated returns. That's a major financial theory. And the theory from hedge funds and some of these other financial market players is that, well, we can invest in the insurance industry. We can start our own reinsurance company. And so a lot of hedge funds have been moving to Bermuda. Bermuda, as you know, is an island nation to the east of, I don't know, Virginia or so. You can check my geography. I'm not a professor of geography, but anyway. So a lot of money's been moving into Bermuda, something like $500 billion in the last few years. And that money has been to start these retrocessions, which are providing capital to reinsurance companies, starting their own reinsurance companies, and starting alternative risk transfer ventures like cat bonds and sidecars. And so they're just trying to get a piece of the risk market. They say, okay, well, the return that we're going to make over a 2 or 3 year period is based on a hurricane, or it's based on a tornado, or it's based on a wildfire. It's not based on the stock market. So that's why we've seen a lot of movement from hedge funds.
Great, thank you. The next one comes around the topic on the market change. And so the question is, do insurance companies have to have their premium rates approved by regulators before they can charge insureds?
Yeah, that's a good question, especially as it pertains to catastrophes. And so this is one of the big drivers of insurance availability. I mean, we could say that if prices were as high as insurance companies wanted, they'd sell as much insurance as they could. You know, if an insurance company can just raise their rates by 100%, 200%, they'll sell it all day long at that price. But people won't pay it. And another important factor is that in many states, the insurance company is not allowed to raise its rate unless it gets approval from the regulator. So for an insurance company to charge homeowners more, they have to have approval by the state insurance regulator. And oftentimes the regulator is not willing or doesn't want to do that for a consumer protection, from a consumer protection point of view, or maybe for another reason they don't think it makes financial sense. So this is the difficulty for a lot of insurance companies. Reinsurance companies do not have rate regulation. They can charge the insurance company as much as they want for reinsurance because it's a professional insurance contract. It's from expert to expert, both experts on risk transfer. So reinsurance can respond very quickly to price changes. If they want to raise the rate, they can do so at the next round of contract renewal. Homeowners insurance, primary insurance companies are not as able to do that. So oftentimes they have to keep their rates at a certain level, or a rate change has to be approved by the regulator, and that approval may or may not come. So that's kind of a tight spot that some insurance companies are in, and that's why we saw, I think, after 2005, a lot of insurance companies pulling their business out of the Southeast United States. They said, well, our reinsurance rates are too high, and the risk is too great. We're not going to see the return that we require.
Great, thank you. I think we have time for probably one more question, and I apologize to those we couldn't get to. I actually find this question very interesting. Is there a catastrophic event the industry could not handle?
Well, I would say almost certainly yes. I can't give you an example, but I'm sorry, I can give you examples. I can't give you a definite answer on this, but we could see a major hurricane that, rather than hitting, Hurricane Andrew in Florida hit Homestead, Florida. That's where I don't know about the eye of the storm, but the major power of the storm went in at Homestead near Miami. Homestead, I think at the time, was a mobile home community. So we're not talking about really valuable places. But what if Hurricane Andrew, a Category 5 hurricane, what if it had hit Miami Beach? What if it had hit South Beach? Well, damages may have been, 4 or 5 times as bad as they were then. The Northridge earthquake, very powerful in California in 1994. What if it had hit downtown Los Angeles? What if downtown LA was racked by just a major earthquake, one of the same magnitude that hit Japan in 2011? So these are the type of events that maybe the insurance industry could not handle. So we don't know. I think I hate to give you kind of an ambiguous answer, but we don't really know. What we do think is that the insurance industry is very well capitalized right now. They have a lot of money in reserves, a lot of money in surplus. Anecdotally, from speaking to many insurance executives, I can tell you that a lot of companies are keeping a year of cash flows or more in reserves so that they can pay for these major losses. So we think that the insurance company is very well prepared to pay for these catastrophes, and also because reinsurance is so widely available, both through the reinsurance market as well as through capital markets, we think that insurance companies are pretty well protected through this secondary risk transfer as well. So the answer is, I'm sure that there is a CAT event that the industry couldn't handle, but I think if we got to the level of a CAT event of that size, the government would step in and start providing a lot of relief as well, as we've seen in like Hurricane Katrina and some other examples, Sandy, for example.
Great, thank you. This has been not just that question, but the overall session has been very informative. Do want to take a moment to thank you, Dr. Puser, for your time and participation today, obviously your expertise. In addition, we want to thank all the participants who were able to listen today. Finally, a reminder that we have 2 additional seminars that remain in the 4-part series. With that, Sean Sloan with CSG will share information on those programs along with some final thoughts. Sean?
Thanks, Jason. As I mentioned at the start, this webinar will be archived in the CSG Knowledge Center and by the Griffith Foundation. So if you missed any part of the program or would like to recommend it to a friend, it will be available soon. Our next webinar is scheduled for October the 11th at 2 p.m. when we will hear from Professor James Carson from the University of Georgia on the topic of life and health insurance. On behalf of the Griffith Foundation and the Council of State Governments, I'm Sean Sloan at CSG headquarters in Lexington. Thank you for joining us. Good afternoon.